Thank you for attending our weekly forecast. My name is Jay Norris. I teach trading at Trading University. As always, we need to remind you that trading involves risk of loss and is not suitable for all investors. First market we'll take a look at will be the Australian US dollar. Aussie USD had a pretty sharp correction here in sympathy with that strong US jobs number. Big jobs number led to dollar strength on Thursday, just ahead of the 4th of July holiday in the U.S. here. It did a little bit of technical damage. Essentially, you shifted that 5-day pattern lower, very short-term pattern. However, overall, we see this leg up really that began at the end of May. We still see that as intact. So we think this market is on pace to get above that 96 level, which we've talked about a few times over the past 6 months or so. So we think this overall bull move that began beginning of the year is still in place. We'd have to revise things short term if you were to really eclipse, 93 even. If you had successive closes below 93 even, we'd definitely take a look at the short side. We'd shift really in short and intermediate term from buying dips to selling rallies. That hasn't happened yet, though. As long as you're holding above 93 even, we're still in the buy the dip camp in the Aussie US dollar. Next market, dollar chief, the dollar Swissy. This market's a cool example of your different trading dimensions. We talked about this last week, where this pattern, this rally that began in May of this year, it's still a bullish pattern. So this overall pattern from May to here is still bullish. As long as that buy zone held, and it did, you barely got in the buy zone, and you had a pretty good rally out of there. Obviously, you were supported by pretty friendly fundamentals for the U.S. dollar. Again, that U.S. employment report, nearly 300,000 jobs added. That's definitely a big plus for the U.S. economy. That shifted the short-term trend higher. Here we've been showing you our RTT ratio, and this is how we teach at Trading University, and this is how we encourage our students to trade. You take any 3 successive patterns, take the 10 through 50, and you trade in the same direction as the majority of patterns. Real advantage to that in that you're going to take away what you think you see on the chart. Here, I'll put that back. Chart's a funny thing. It's a bit like an illusion. I've said it many times. We tend to see what we know. We tend to look for what we know to reinforce our own belief system. So chart can be a tricky thing. That's why I like the ratio. It just breaks it down. It's very black and white. So basically we're back to buying dips in the dollar Swiss on the upside. So we're back to buying dips here. Well, I'd love to get a double bottom in that zone. That'd be perfect for me. But we'll see. I'm just as guilty as everyone else is looking for what I know, and therefore really not seeing what happens most of the time. So I'm just going to stick with that method. We're back to buying dips in the dollar chief, and in the next market, the dollar index also. Dollar index, very similar chart. You can see you stretched that. You had the overreaction on the big number. They stretched it a little bit. Bam, you hit resistance based on that high, that low. You hit resistance already. So back to buying dips. Just keep it simple. We've looked for support in that zone again, in the form of, I love a double bottom, but we'll see what the market gives us. Here's our ratio for the dollar index. There it is, where regardless if you trade the 5 through 25 or you trade the 10 to 50, you have the majority of patterns are up. So we're back to buying dips in the dollar index. Next market, the euro US dollar. What you want to see in the euro US dollar here is the shallow retracement that you saw in here, that you saw in the second half of June. This is a big down move, and you had a pretty shallow retracement. Couldn't even get back to the purple line. The purple line, of course, is our 50%, so you couldn't even get a 50% retracement out of there, so you stalled out maybe around 382. So very shallow retracement. That speaks of long-term weakness in this market. Speaking of long-term, look at that pattern. You still have a higher high and a higher low in the big picture, right? So we're looking for a lower low to confirm that this pattern, I guess we could say from here up, that pattern has finally shifted bearish, right? So overall, we're looking for longer term weakness here, and short term got the short term weakness. Rather than just trying to analyze the chart, let's just show you the ratio. There you go. take any three successive patterns, trade in the same direction as the majority of those patterns. So no matter how you slice it down on these short and intermediate term time frames, even those longer ones, for the most part, we're looking to sell rallies. So we're back in the sell the rally camp. In the euro US dollar, again, let me remind you, that's a pretty shallow retracement there. Generally, shallow retracement is a mark of weakness in a market. Covering the gold market next. There it is, and you can see that 618 resistance held in the gold. You had a test of that. So basically, you're in our sell zone here. We're not all that active trading gold. I think commodities, they tend to be a little bit more volatile than the currencies. Therefore, they're risky. The higher the volatility, the more risk. So we're not big players in this market by any stretch. It's fun to analyze it though. So you're still in a sell zone in the gold long-term sell zone. You want to see the big picture, we'll pop out to a weekly chart, and that's where you could see that pattern of lower high, and you're in an area where potentially you could make another historic lower high here for another leg down. So gold, nothing changed there. We really see this is more or less a short-term rally, and it wasn't really any news here. There was nothing specific. Like, you could point to dollar strength on Thursday. That was specifically because you had employment number that was very strong that supports a long-term trend in employment in the U.S. Here it was just status quo. The Fed saying what they always say, and that really just sparked a short covering move. So it wasn't necessarily new buying in the gold here. So longer term, we still have to respect the sell zone that gold is currently in. Here's dollar yen, and boy, dollar yen's been kind of boring, and this is actually long-term characteristic of this market. You can see I've been a broken record since the beginning of the year, since February. It's just a big sideways pattern. As I said, historically, that's nothing new here, because when you go back in time, you see these pennants. Here's a big pennant, it was a 6-month, 7-month pennant before you had a breakout. Here you're in the midst of a 6-7 month pennant also. And again, nothing new. If you go back to when this market had that historic bottom in 2011 and 2012, you saw it went into a long-term 6-month pennant here. Here's like an 8-month pennant right there. So the market likes those long-term pennants, so it's going to break out when it's going to break out. Probably not a bad idea to start accumulating smaller positions longer term on the dips here. And I say smaller because we don't know. Factually, we don't know which way it's going to go. It could give you a fake break south before it rallies. That's a favorite market tactic. However, we think long term that this is a market that it's more likely to break out on the upside than the downside. We think 108 is still a viable upside target. So 108 long term upside target for us. Here's your monthly chart, and we just think you'll see that in the high 107 handle, 108 handle. We think that would be a natural upside target for this pennant when it breaks out. There it is. You can see that pretty big pennant. As I said before, if we like it at 101, we love it at par. But realistically, we think the high 107 handle, 108 is in the cards for us by year end. Thank you so much. I'll leave you with this thought. All we need from the market is for it to provide us signals so we can take the appropriate action. And that's so true. Allow the market to tell you what to do. Try to take yourself out of it. And the more experience you have with that, the easier that becomes. Thank you so much, and we'll see you next time.